Which mid-cap sector you will completely avoid?
IT industry. So majority of investment at this point in time is moving into countries like South Korea or Taiwan. I won't be surprised. I mean, crude again going back to almost like $120 plus. I am more than happy as a portfolio manager when we are looking at the recent drawdown in the market and looking at the volatility. Actually, it is helping us to construct portfolio. If we have to look at from medium to long term, I think these are the best opportunities to look at the investment.
I have with me Rohit Jain. Rohit Jain is a chartered accountant and portfolio manager with Purnartha. Hi Rohit,
Yeah, hi Hemant.
how are you doing?
I'm good. How are you?
Very good, very good. Rohit, can you share us about your experience as a fund manager, how the journey has started and how has been journey so far as a fund manager?
So I started my journey as a fund manager in 2021 when I joined Purnartha. So initially I was working closely with our CIO, Mr. Rahul Rathi. So I used to support for his fund in terms of the research and in terms of management of portfolio. Then we started with a new fund in Feb 23, which is the Purnartha Dynamic Midcap Fund, and I am then acting as the fund manager for Purnartha Dynamic Midcap Fund. So that's where my journey started as a fund manager with Purnartha. So initially the thought process was to have even the separate research team altogether because the investment philosophy or flagship product, which is Purnartha Pratham, is slightly different than what we actually were going to try new as part of the Purnartha Dynamic Fund. So we started with a separate research team. It took us like 2-3 quarters in terms of setting up team, in terms of then having coverage on roughly about like 120 companies, which we are actively tracking at this point in time. So with this, then we started our portfolio journey and the construction of portfolio with the thought process and the framework which we are having specifically for Purnartha Dynamic Midcap Fund.
Right. So Rohit, right now a lot of clients are asking about how is the market right now, and also a lot of clients are also worried about the impact of the war. So what is current view on the markets, and what do you see as an impact because of the current war condition on the markets?
So, frankly speaking, from market point of view, even we are a bit uncertain in terms of the giving outlook from short term to medium term point of view, because it is very uncertain market conditions, and depending on, I think, couple of people who are driving some of the, I think, the geopolitical issues which we are facing right now. But keeping this thing aside, so we are seeing multiple headwinds in the market at this point in time, and it is more to do in terms of the global market. The first and foremost, we started with all these trade-led disruptions in the market, right? So with then the intervention by the Supreme Court of US, I think this is at least at the back burner at this point in time. But still, I think the US may keep on changing. I think some kind of, I think the policies around the trade in the coming future. But the good part about India, I think somewhere down the line we are going to enter into some kind of agreement with the US, which I think will provide some kind of clarity from the market point of view. The other aspect, in the meantime, India is continuously entering into FTA with many other countries.
Right.
So recently we signed agreement with Europe, even we signed agreement with UK and Australia, and we are in the process of continuously expanding our FTA market, which I think is going to be very positive from medium to long term point of view when India as a market is concerned, because it will be a level playing game for the India, and it is continuously expanding India as a market. The second bigger issue which we are looking at or seeing from the market point of view is the disruption led by AI, Gen AI.
Right.
So there are two aspects again to it. One, the direct impact because of AI, Gen AI on the India market, and then few of the sectors which are actually depending
Especially, I
on
think
the.
IT has a significant
Yes,
impact.
yes. I mean, IT, if you look at, India has been lacking investment into LLM of its own.
Correct.
So right now, India is actually behind when it comes to the investment on AI, Gen AI, at least when it comes to the creation of the infrastructure. But now with, I think because of these LLM, I think they are providing, I think, direct threat to our Indian traditional IT companies. So therein then the chances of, I think, the deflation with then reduced scope of work which actually putting some kind of threat to the top line of majority of Indian IT companies. So which has already come down to, I think, a low single digit number at this point in time. So in my opinion, how I am looking at this, so right now we are still in the investment phase when it comes to AI, Gen AI. At the top of it, once we are going to see the implementation of, I think the AI, Gen AI in real life situation, and then the implementation into different application across sector, that's where it is going to unfold significant opportunities then for Indian IT companies. So right now there is a threat of job cuts or reduced salaries, which may have a direct or indirect impact on the Indian market. But I think the Indian market is still, I think, is not largely dependent on IT companies in terms of the overall job. So it is still, I mean, the 5 million jobs coming in from IT industry, but it is the very small part of the overall the population and the household families which we are having in Indian market. But sentiment wise, it is having negative impact on Indian market. So I think in next couple of quarters time, we are going to see significant investment then happenings. I think on the AI, Gen AI, led by then the company which is going to unfold significant opportunities for Indian IT companies. The second indirect impact because of this disruption. If you look at FPI, they were continuously selling in Indian market.
Right, right.
So FPI, they used to own roughly about like 22-23% of the overall equity ownership, which has already come down to just about like close to 15%. There are again, I mean, the two or three major part to this continuous selling in Indian market. If you look at from last 1.5-2 year, Indian market deliver very subdued returns. It has been a low single digit number from FPI point of view. So because of subdued return, and at the top of it, you are having 4 to 5% kind of INR depreciation.
Correct. Currency is
So
impacting.
in dollar term, you are not making any significant money in Indian market.
Right, right.
So from investment point of view, then India was an attractive market for FPI, and hence we have been seeing continuous selling in Indian market. The other aspect, because of this FPI, the other reason for FPI selling has been, I mean, they have been investing in economies of the companies, which were actually they're investing significantly into AI, Gen AI ecosystem.
Right. I saw about
So,
Taiwan and
yes,
Korea.
like you rightly said, I mean, so majority of investment at this point in time is moving into countries like South Korea or Taiwan, even the countries like Brazil, who are still as part supplying some kind of raw material which are critical for the semiconductor or maybe the chips which are required to set up the infrastructure to support your AI investment. So that's where we have seen majority investment then moving into countries like South Korea, even Taiwan, and then America. And even when you look at, I mean, the America, I mean, I think the majority of rally led by very few companies.
Right.
So historically, we have seen rallies led by few sectors. If I have to speak about like Indian market, we have seen significant rallies happen because of then the boom into infrastructure or maybe real estate or maybe telecom or power generation. I mean, at different point in time historically. But once we have seen the maturity into those, and once they reach to some kind of saturation, then these sectors never participated in any of the rally in subsequent years.
Right. So
Or we even have seen some kind of even bubble building into few of those sectors. So that's where we think this FPI right now it may be a sector specific rally which may last maybe for couple of quarters. And AI, Gen AI, we don't think it is an economy in itself. It is still just about like providing support to the basic economy,
correct.
which we think is roti kapda makan. So in terms of FPI ownership, which I was talking about, uh, the best part which has happened from India point of view, and the kind of ownership which has already come down to about like 15%. So there has been a shift from then wholesale ownership, then probably the retail ownership,
Retail, as in you're
which
saying the mutual fund.
mutual fund, even then mutual fund, I mean investing because of significant participation from the individual retail investor
Right.
who are continuously adding money into mutual fund. which is reflecting in terms of the SIP money which is coming in the market. So that's where I think it is making Indian market very robust at this point in time. The kind of FPI selling which we have already seen in last 1.5 year, and if it would have been the case maybe a couple of years back, I think Indian market is still holding up well
Significant
in terms of the
correction.
drawdown that we have seen.
Right, right,
So this is because of, I think, some kind of shift in the ownership from then wholesale to retail.
right. Rohit, what kind of opportunities you see in the market right now? Because of the war, there might be certain sector which might open up because of the war kind of scenario. So, in short, what kind of opportunities you see in the market right now?
So, see, because of war, I mean, the outcome is depending on, I think, is US and Iran, and what kind of agreement they reach to actually call the ceasefire at this point in time. Uh, but I think it is the question of what, when, how, rather than, I mean, taking any precise call in terms of the timing on any of these
Right, right,
aspects. So if I have to look at opportunities from market point of view, so there is definitely a clear-cut opportunity of 5 to 10%. And
okay,
once we reach to some kind of agreement, then we can see some kind of, I think, the overall rally in the market to the extent of 5 to 10%. Coming on to sectoral, I mean, the crude oil prices, I mean, which I think is one of the key, I think, driver in terms of the inflationary pressure that we are seeing in Indian
right,
market.
right,
And I won't be surprised. I mean, crude again going back to almost like $120 plus if the
oh,
situation remain like this.
okay,
So how we are looking at opportunities in the sectors, I think it is good to look at sectors wherein the companies have ability to maintain some kind of volume growth, and companies, I think, they can protect their margins in these inflationary pressure. Because I think for Q, many of these companies reported their results with, I think, they were able to maintain their margins, but the actual impact is yet to come.
right,
That's where I think the 1Q is going to be very critical from market point of view. So from sectoral positioning point of view, if I have to look at, then I think it is good to invest maybe in sectors like private banks or the few of the diversified financials, wherein we have been investing in companies like BSE or maybe some of the exchanges
right,
and the mutual fund, and maybe some bottom up opportunity in few of the subsectors like cables and wire, hospitals, wherein we are very bullish, and we see some kind of structural growth stories in the coming years. From medium to long term perspective, if I have to look at the broader thesis to play around on the sectors, we spoke about AI led disruptions, right? We are yet to see the second level impact on the industries
of the AI.
of the AI, because we are just looking at investment happening on the infrastructure side,
Right,
but we haven't seen any companies talking about saving on their operating cost, or maybe some kind of productivity gain which can happen because of AI Gen AI.
right,
So probably we are going to spend some time on identifying opportunities wherein the companies can gain advantage of this AI-led
productivity improvement.
implementation, which will help them to improve their productivity, which will help them then better customer experience and then the higher volume growth.
Right,
So
right.
those are the few themes and sectors which we are looking at from medium to long term point of view.
Sure, sure. Thanks, Rohit. Rohit, again, any specific impact or your view on mid cap and small cap, because Purnartha Dynamic Fund is specifically towards mid cap. So, any specific view as a mid cap as a segment or a mid cap plus small cap as a segment?
So, if you look at India as a market, so the best part about India as a market, I mean, we have good precedence in terms of whatever we are doing, whether in terms of any decision making, policy making, or anything around like central or state government in terms of the functioning. We have good precedence, and we can just go and look at what has happened to developed market. So, and when we speak about India having per capita income of $2,200, and when we compare it with the per capita income of US when they actually had sometime maybe many decades back, and when we look at all these developed market like Japan or South Korea or the China and the evolution of their economy, we have seen from this $2,200 per capita income with then significant policy support to promote manufacturing in India through many of the other schemes like Make in Bharat or maybe PLI. I think from here on, then the mid cap and small cap companies will continue to do well,
Okay.
because this is kind of, I think, the evolution we have seen into developed market, wherein they were at this per capita level and the economy was growing at 6 to 7% in terms of real GDP. And if India has to grow at these levels for next decade or so, then I think it is good to remain invested into small mid cap, because large cap companies, they may largely grow in line with your nominal GDP growth, which may be in the range of 11-12%. If we have to look at 6-7%, I think the real GDP and 4-5% kind of inflation. So the large cap companies may deliver probably 11-12% kind of return in line with the nominal GDP growth. But small mid cap companies, given their size, they may not be market leader in the industries or the sectors in which they are operating. But given this, the growth which we are looking at for the broader market, I think it is good to then remain invested into small mid cap companies.
Sure, sure. Uh, that's great to know. Also, how do you then arrive at a universe of small and mid cap? Obviously, every company would not do well. So,
Correct.
how do you arrive at the investable universe for Purnartha Dynamic Midcap Fund?
So in Purnartha, so we are already looking at couple of filters. So one is uh, the first and foremost. I mean, we want to invest in companies which are having very strong balance sheet. There shouldn't be any corporate governance issues,
Right.
and the quality of promoters and the professional management. That is the first and foremost which we look at, even while starting looking at a company at the beginning.
But how do you identify if
So
the promoter quality is good or the corporate
So,
governance issue is not there? I
so
mean,
why we are then more comfortable investing into mid cap companies? Because you have a history around those companies, whether it is financial performance or share price performance, that actually suggests, that is, I think, first and foremost indication then to take a call on the quality of a promoter. So just to give an example, I mean, there are many companies. I mean, despite being late entrant in the market, but then, because of quality promoter and the management, they are aggressively growing much faster than the industry. They are continuously gaining market share.
okay.
That gives some kind of indication. I mean, then taking call on the quality of promoter. So that's where I think mid cap companies, given their decent history, they are well placed in terms of then the judging on the quality of those promoters. Second aspect, in terms of the balance sheet, which I was talking about. So we are investing in companies which are having very strong balance sheet. We are restricting our universe to about like zero point 0.5 net debt to equity. So we
Okay.
are filtering out all the companies with higher leverage, because I think that is something, if there is anything goes wrong in the market, I think these are the companies which actually take hit at first place. We have already seen this thing during financial crisis. We have seen this thing even happening on the COVID time. So in COVID time, all these leveraged companies, they were struggling to manage their balance sheet. When the companies which are having a strong balance sheet, they were actually taking advantage
Right. Right.
of their disruption led by COVID. So these are the few filters which we apply, reaching to I think the universe, which is almost like of 120 companies.
So Rohit, you mentioned that there are about 120 companies which you shortlist with the process which you rightly mentioned. So now how do you go about constructing the portfolio out of this 120 companies? Is there a specific framework or what is the research process, to construct the portfolio out of this 120 companies which you said?
So if you look at construction of portfolio, so we are following a specific investment framework which we call it the GSM framework. So G is stand for growth.
Okay.
So we are looking at companies which are the growth oriented companies, wherein the companies are growing maybe at 18 to 20% top to bottom. So and these companies are having very strong business model, and these are sort of like structural growth stories which we are looking at as part of this bucket. The second aspect is the margin expansion. So we are looking at companies wherein the companies are looking at expansion in the margins, again because of some kind of the headwinds which they had in terms of the raw material prices now turning into tailwinds, or maybe because of the operating leverage looking at the growth of these companies, or maybe the companies which are moving into value added product. So therein the company's top line may remain moderate, but with the expansion in the margin, you can still expect like 18 to 20% kind of bottom line growth. S stand for strategic investment, wherein we are looking at again two things. The one is the valuation aspect, and other one is if there is any special situation. So in terms of the valuation, so there may be companies which may be trading at like historical low levels in terms of the valuation of those companies. It may be because of some kind of sectoral headwinds, or maybe some kind of company specific headwinds. With then things to normalize,
These are
then
like
you
turnaround
can,
stories, is it?
preferably yes. So when things normalize, then you are going to see again then some kind of re-rating happening for these
Right.
companies and reaching to the normalized level. So there can be an investment opportunity which can keep on coming around those valuation aspect. The second part of this thing is the special situation wherein we keep on exploring opportunities if there are any buyback happenings or any merger or demerger happenings. Like recently, we have been investing in a company which is trading at significant discount to its target company, and after the merger I think the discount was supposed to go and bridge it. So we are investing into the target company rather than investing into acquirer company. So this is the broad framework of GSM, which you call it growth and strategic valuation and the margin expansion depending on the market conditions. Then we keep on switching our portfolio positions as part of this framework. So when we are maybe like if I have to speak about the recent time wherein we are going through the inflationary pressure. So now we may even see some kind of opportunities emerging on the margin expansion and the valuation side. Because prior to this inflationary pressure, I think majority of these companies are operating at optimum levels of margins. But with these inflationary pressure now, we are going to see some kind of, I think, the fall in the margins. And once we see crude oil prices then
Going
reaching to
back to normal.
normalized level, then you may see these margins to normalize to their historical
So
averages.
basically, we are saying that because of this war kind of situation, it might provide you a good opportunities to
As
invest.
part of the G and M, growth is something which we have been looking at in and out throughout the years. But what happens, I mean, because of this war-like situation, we have seen drawdown, right? So what we do normally, whenever there is a fall in the market, we actually increase our allocation towards growth-oriented companies.
Okay.
Because what happens, I mean, the companies which are growing consistently, majority of these companies have been trading at significantly higher valuation. So with the drawdown in the market and overall market, if it is falling down, we are even seeing correction happening into those companies as well. So at those time, I think then the best aspect and the portfolio action which you can take is to increase allocation towards those structurally strong businesses.
Right. So this kind of situation provide opportunities for the investment
That's
strategy.
where I am more than happy as a portfolio manager when we are looking at, I mean, the recent drawdown in the market and looking at the volatility. Actually, it is helping us to construct portfolio which can deliver solid return from 3 to 5 years point of view, rather than worrying too much about this
Short term.
short-term volatility. Uh, if we have to look at from medium to long term, I think these are the best opportunities to look at. I think the investment.
We talked about research framework. Let's talk about more. I want to understand how the research process works. How is the team structure in terms of research? Once you identify a company or a sector,
So at Purnartha, we are known as a research house than any wealth outlet. So we aren't depending on any external agencies for our research. We have a very strong and experienced research team wherein we are actively covering around like 120 companies which I already spoke about from the universe point of view. As part of the research, I mean, first we start look at a company, we look at its positioning in the sector, and how the what are the business model which a company is having, and then only we start then looking at those companies more in detail. So we have and build our own models. First, we look at the historical financial history of a company, wherein we look at the income statement, balance sheet, and cash flow of those companies. Because we think, I mean, whatever has happened in the history is something which is going to repeat in the future as well. Just to give an example, I mean, if we have to look at the oil prices again, oil prices has gone to $120 even in 2022.
Right.
So if I have to look at the historical number of a company and what was the impact on the volumes and probably the margin of those companies then
During
in
that.
2022 is something which we can even expect at this point in time, probably in the 1Q and maybe in the coming quarters. So historical number gives you good idea about the company's performance in different cycles and different economic environment or even the inflationary pressure that we have already seen. Then we do our own forecast of those companies.
Okay.
And our conviction on investment, we are drawing it in terms of the forecast which we are doing and what kind of conviction we have on the growth of a company. That gives me more confidence in terms of building a portfolio and then investing into those companies. Because as a fund manager, we don't have control of, we can't predict the share price movement of a company. What we can predict, and if we can predict the financials of a company very precisely, that is giving me the confidence in investing into those companies.
Okay.
And at Purnartha, I think the earning growth of a company is giving you then the share price performance in the coming future. That is going to reflect in terms of the share price performance of a company.
Right. Right. So Rohit, we talked about now how do you select the company. Can you also throw light on any specific don'ts that or anything, any specific sector or any specific framework you want to avoid mistakes. So any don'ts when you're
So in
doing a
terms
research.
of don'ts, if I have to flip the selection part and then look at the other aspect, like I spoke about, we are investing in company having very strong corporate governance. So the other way aspect, I mean, we don't invest in companies wherein if there have
There's
been
a
any corporate
corporate
governance
governance
issues
issues.
historically. We spoke about, I mean, we are investing into companies having very strong balance sheet. So a company which is having high leverage, maybe beyond 0.5, is something then we have been avoiding. So these are like few companies which we are avoiding and don't want to invest into those companies. We are even avoiding few of these sectors.
Okay.
Like we aren't investing into oil and gas and telecom. Again, because of the leverage issues. We don't want to invest into companies operating into real estate, because in real estate, I think we don't have much of conviction in terms of the financials of majority of real estate companies,
Okay.
and then the conviction on the cash flow statement of those companies. We are avoiding companies on the media side. It has nothing to do with in terms of the don'ts, but media, I think we think there are structural shift happening from then I think the traditional platform to then I think OTT,
Digital side.
so digital side. So these are like couple of sectors and few filters wherein we don't want to invest into companies or the sectors.
Sure, sure. Thanks, Rohit. Rohit, also, can you share more examples? I'm sure you would have found a lot of multi-baggers in last 5 years of, managing dynamic mid-cap. So if you can share a few examples of, how you went about finding multi-baggers and or what was your initial idea about that company and how did it pan out? So if you can share some case studies or examples of multi-bagger, which you have found.
We actually had many multi-baggers in our portfolio in last like three and a half year. And couple of companies, even when we started investing, they were like small mid cap, and they actually ended up being part of Nifty 50 now. So one of the company, if I have to pick, maybe if I have to speak about company like BSC. So BSC actually tried to enter into FNO market loads many times historically,
Right.
but they are actually unsuccessful. I mean, now what has happened? Sometime in 24, they this time around they actually came out with different expiry day for the option trading. So
Different than
they
the NSC, you're saying.
different than the NSC. So NSC had expiry on Thursday. So they actually launched Sensex and Banks Sensex with then expiry on the Friday and Monday.
Okay.
That was one of the key game changer for BSE. So from 0%, they started having their market share of at least like 7% in just about like couple of months time. Then there were talks of, significant volumes happening on the FNO side. So SEBI actually intervened to actually reduce the volumes on the FNO side because they are thinking, many of retail investors, they are incurring losses and the profits were actually moving to few of the HFTs which are operating in the segment. We were of the opinion, whatever be the change in the regulation, looking at the market share of BSE, I think it is not going to have any impact on BSE. If it has to, it will have impact on the NSE. That was the one thing wherein we are convinced, even if there is any regulation change, I think BSE will keep on gaining their market share on the option side. Subsequently, what happened? The SEBI actually came out with first one product, one exchange on a weekly expiry basis. So SEBI actually came out with Sensex and Nifty then had the Nifty 50. So there wasn't any bank Nifty then on the weekly expiry. Then we were of the opinion, if we have to look at the volume on the options when we are having weekly expiry on the Bank Nifty was having more volume than Nifty 50. And the reason being, there were lesser number of companies as part of Bank Nifty. That's where we think Sensex being part of just about like 30 companies, where Nifty is still comprised of
50
like 50 companies. So we think from option point of view, I think it is good to then invest into Sensex then I think Nifty.
Okay.
From 6-7% market share. BSE market share right now is close to 36-37% now. They have seen phenomenal volume growth on their, I think, the options side. That was one thing, which we actually played in terms of the BSE. From here on, if you look at the cash market of BSE, it is still hovering around like 6-7%, right? So we don't see any downside risk in the cash market. But with the listing of NSE, I think therein probably it will help then to gain some kind of market share on the cash segment as well for the BSE. So it is still very well placed in terms of the market share gain, whether it is FNO side or maybe on the cash segment.
That is very interesting.
The other stock, if I have to speak, which turned the multi-bagger for us, look at the company like Lloyd's Metal. So Lloyd's Metal, they were holding a mining lease for almost like 15-20 years with no, I think, the growth in terms of the volume. They couldn't actually mine, and their mines are located into Gadchiroli area. So Gadchiroli area, it's a Naxal area. Central government, they were very keen to actually make it then to basically remove the entire Naxal activities into those areas and to create some kind of job and businesses into those areas.
Okay.
So to begin with, they started and they promoted and provided good policy support to players like Lloyd's Metal, wherein they started from zero iron ore mining to it reached to couple of, I think, 1 or 2 million ton to begin with. It reached to almost like 10 million ton in a span of like 2-3 years. 10 million ton they received, then further EC then to have production till 55 million ton. So this financial year they ended up with the volume of 21 million ton.
Okay.
So there has been significant volume growth in terms of the iron ore mining, which is then reflecting in terms of the share price performance of this company. The best part about the mining of Lloyds is, if you look at Tata Steel and SAIL, probably they are the lowest iron ore producer at this point in time. Their mining lease are expiring by 2030.
So you're talking about Tata Steel and the sale, their
SAIL,
expiry.
their margins, their mines are actually expiring in FY 2030.
Okay.
So these mining will come again through auction route. So therein your the premium which you are going to pay in the name of royalty and the premium, it is going to be much higher. Wherein in case of Lloyd Metal, their mining lease is going to expire in 2057.
Oh.
So it is close to like 30 years. I think probably, in my opinion, they can remain the lowest iron ore mining producer in India. Their intention is to move to the steel manufacturing in a span of 1 or 2 years time. Probably they can become the lowest steel producer in India. So we think, I think there is significant growth opportunities when it comes to even Lloyd Metal, even from next 3 to 5 years point of view.
Rohit, can you share more details on how do you go about constructing the portfolio?
So in terms of construction of portfolio, first we are investing in all major sectors. We don't want to miss on any of those sectors because we think all sectors may not underperform at the same time or outperform at the same time. So timing a sector is very, very difficult. So barring sectors like oil and gas or media or real estate, which we already spoke about, we are investing all across major sectors. So we are looking at roughly about like 18 to 25 companies from portfolio point of view. When we are saying 18 to 25 companies, in our opinion, it is a concentrated portfolio then to look at, I think, the decent alpha over the benchmark. But then significantly diversified if we have to look at our sectoral exposure and the subsector even within few of those sectors. In terms of allocation, we are looking at 3 to 8% kind of allocation on individual companies.
Rohit, we talked about the framework. We also talked about the research process and the construction of the portfolio. I think another important aspect is when to sell. How do you exit? So if you can help us understand, when do you decide to exit particular stock?
So I spoke about our investment framework, right? When I spoke about the GSM framework. So whenever we are investing into any company, we have certain investment objective in our mind. So if we are investing, let's assume company as part of the growth oriented. So as long as companies are growing like 18 to 20%, we'll continue to hold on to those companies. When we are talking about the margins or the valuation aspect, so once they reach to normalized levels of margins or the valuation, we'll exit into those companies. So we don't have certain price target in our mind. Once we reach to those investment objective, then we will exit from those companies. The second aspect, in between, then what we can try to do is we even trim down our positions in few of the companies, even if they are in line with our investment objective. Because at times we find risk reward, if it is not favorable, then it is good to trim down positions into certain companies rather than keep on holding on to those companies. Because market dynamics are changing very fast because of, I think, the change in the technology or the competitive forces. So if you look at, we invested a company like Endurance Technologies about like 1.5 years back. So again, endurance, it was a margin expansion style which are trying to play around endurance technologies. So like 1.5 years back, we have seen again significant rally in the commodity prices. Aluminum prices, they were actually continuously growing. So because of headwinds in terms of the aluminum prices, the margins actually compressed. Even that was reflecting in terms of then the fall in the share price of endurance technologies. So when they actually fell down, that was the time then to enter into this company, because we are expecting margins are going to normalize either with the aluminum prices coming down or the company's ability to pass on these prices then to their end consumer. So we entered into company at lower end, margins actually normalized in subsequent quarters. Even that was reflecting in terms of then the improved share price of endurance technologies, and then we exit from endurance technologies once actually margins
Margin
normalized.
expansion then played out
Yes,
as per your
yes,
expectation.
yeah. So we have certain objective in our mind. We have certain investment objective once we meet to reach to those objectives, then we exit from those companies.
Yeah. And typically, what will be the churn in the portfolio, right?
So churn you can expect probably one in a quarter kind of companies in terms of the churning. So probably 3 to 4 companies in a year. So it's 18 to 25 companies. And if it is part of the growth oriented, then probably the holding period may be in the range of 2 to 3 years. And when we speak about the margin expansion or the valuation aspect, then the holding period may be in the range of 12 to 15 months.
Rohit, can you share more light on what is scuttlebutt analysis and also some example of scuttlebutt analysis which helped you to decide whether to buy the company or probably avoid the company based on the outcome?
So, as part of the overall research process, scuttlebutt analysis is the most significant aspect of it. Uh, After doing the fundamental research and building a model, I mean, scuttlebutt actually gives you then the ground realities about a company. And to be very frank, I mean, it has been the core part of the Purnartha's overall research which we have been doing throughout the years. And just to share an example, I mean, so we are contemplating investment into value retail. So we are looking at names like Vishal Mega Mart and V2 Retail and V Retail. So I visited to their stores in Guwahati because in Guwahati you have all the 3 stores. So when we went there, we visited to V2 Retail. I mean, so their product positioning, I mean, it was slightly different to what actually company has been saying. And even it wasn't much crowded. We found then inventory being a little bit older as compared to the company talking about the fresh inventory which they have been changing time and again. And when we went to Vishal Mega Mart, then the experience was completely different. I mean, there in the kind of inventory they were having, it was very fresh inventory and it was very crowded as well. That was the point. I mean, then we were a bit skeptical then investing into maybe company like V2 Retail, wherein the company has been talking about the hyper growth and freshness of inventory and the crowds and all those things. But somewhere, I mean, we are not then satisfied after visiting to the retail store.
Rohit, also I think risk management is a very critical part of overall portfolio management. So at Purnartha Dynamic, how do you manage risk, or how do you see risk, and how do you actually manage it?
So, risk management, if I have to speak about like quantitative aspect of it, so there are you can look at the beta or annualized volatility or the drawdown and the kind of recoveries portfolio or index is making, right? So in terms of beta volatility or the drawdowns, our portfolio actually had similar kind of drawdown and the beta in line with the index. So when we speak of the market fall between September 24 till April 25, market declined by almost like 16-18%. Our portfolio was down by about like 20%.
Okay.
In recent time, market is down by about like 15%. Even our portfolio is down by about like 15%. But we just recovered in 177 days in the fall of September 24 till April 25. And we reached to then that fresh high in terms of the NAV in subsequent month.
Right.
When BSE 500 is yet to reach to the previous peak. In recent time, Nifty and BSE 500 again fell down by about like 15%.
This
And
is
this
the during the
time,
war
during
period.
the war, like, so from March, Feb until date. So Nifty 50 and BSE 500, they are down by about like 15%. And even we have seen similar kind of drawdown in our portfolio. But we just recovered in just about like 37 days.
Wow.
And our portfolio NAVs are actually at all-time high, despite Nifty being 2500 point away from the previous peak of 26,300, 400 level.
Right.
So these are the reflection in terms of the number, if I have to speak about, in terms of managing risk. Now, in terms of qualitative aspect of it, like I spoke about our allocation of 3 to 8%, and then significant allocation all across sector and subsector. And when we were saying not all sectors are going to underperform,
Right.
that is then the other aspect of the risk management. So we are investing all across major sector, We are investing into domestic and overseas market. We are investing companies which are having then dependency on different raw material as well. This is helping us then significant diversification from portfolio point of view, which comprised of 18 to 25 companies,
Right.
but all the companies are operating into different business environments.
Right.
The most important aspect, which when we speak of in terms of selection or rejection of a company, so I spoke about like we are investing into companies which are having very strong balance sheet. If I am investing in a company with leverage of zero point 0.5, this in itself provide me some kind of support if there are downturn in the market, because these companies, they can capitalize on their balance sheet in favor of the company in terms of these difficult market conditions.
Right.
Like in recent time, there have been see, oil prices has gone up. There have been even challenges in terms of getting supplies if you are manufacturing, let's assume, depending on the LPG gas supplies, right? What is happening? The market leaders now they are gaining market share in these market conditions. When a small player, they are actually finding it difficult to actually continue to run their production. So that is something which a company with a strong balance sheet can actually capitalize in these kind of market share, wherein they can actually gain market share rather than worrying too much about managing their balance sheet. So this is the overall part of I think in terms of the diversification, in terms of investing all across subsectors, and in terms of then look at different markets. I think it is significantly diversified portfolio which actually help us to manage risk well.
Thanks, Rohit. It was a very interesting conversation. We got to know about why should we invest in a mid cap? Is it a good time to invest? Also got to know about the GSM framework. And one important takeaway for me is that whenever there are correction, I think framework like GSM or Purnartha Dynamic Midcap provides a great opportunity, for investment. So volatile market helps us to get into a good company, good quality company, at a right time, and also that helps us to produce better returns. So thanks a lot. It was very interesting session.
Thank you, sir.
And before we just conclude, there is a rapid fire. So I'll ask you 5 questions and you have to answer it in a single word. Yeah.
Yeah, okay.
Let's start. One stock which you can hold on for more than 10 years.
Max Healthcare.
What is the biggest myth about mid cap investing?
I think in terms of the drawdowns.
Okay. Next question. Is it good time to invest in a mid cap?
Yes,
What should be the investment horizon when you are investing in a mid cap portfolio?
should be 3 to 5 years.
Thanks, Rohit. That was a very interesting conversation.
Thank you,
Thanks a
Hemant.
lot and all the best. Thank you.
Thank you, Hemant.
Thank you for watching first session of Purnartha Knowledge Cafe. Please give us a feedback if you have anything in the comment section. We'll be happy to answer and reach out to you. Thank you so much.